The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
So we're at the beginning of a new year, and basically we're dealing with post-2 shortened trading weeks. And January brings us to the inauguration of President Trump and the government having to deal with the debt ceiling. Both of these create more volatility, or at least potentially more volatility for the markets as we move into a new year, particularly this first quarter where we have seasonality issues that weaken and then strengthen as we move through the months that are ahead. The presidential campaign, Trump proposed and promised that we're going to have tax cuts across the board and that there'd be significant tariffs on foreign imports, which has plus and minus views depending upon who's making the examination. So the former, which could be a tailwind for U.S. equities, because we have it following the passage of the Tax Cuts and Jobs Act during the first term of President Trump, and the second could cause some potential damage. But the threats of high tariffs in the past have always been followed with a moderation as negotiations proceeded towards what was perceived to be a more favorable U.S. outcome. So we don't know that the inflationary threat of the high tariffs is all that real, but high tariffs would have a damaging effect on the global economy, which, particularly if you're looking at emerging markets, is already struggling around the world. So as we take a look at this, there's various opinions about how to deal with this. And basically, I went to a database that we subscribe to that is used primarily by professionals and primarily individual money managers. So the questions are, where are you going to be most heavily invested in 25, and its stocks? And basically, if you took a look at some of the alternatives comparing U.S. market to these other issues, bond, commodities, and being cash or crypto, the trend right now clearly favors the U.S. market. And as we turn around and look at where do we see the outperformance coming, it's still in technology. Technology has a lot of subcomponents, but it's certainly stronger as a segment of the market than the Russell 2000, where you find your small cap and mid cap companies, and the Dow, which only has 30 stocks in it, is still expected to be underweighted as far as asset allocation models are concerned. Likewise, as far as styles are concerned, growth remains the dominant sector. Value investing, looking for things that are running across the bottom of the charts, anticipating that they've been out of favor so long they must get better sooner than later. Not always a good bet, but that happens to be the second heaviest area that asset allocation models are expected to be exposed to. The buy and hold, forget about what the market does, that's passive, that's 8.7. In the market that we have today, there's reasons to be passive, and you manage your money differently when you are buy and hold. You don't care if you go through a 35, 40% drawdown and it takes you 3, 4, 7 years to get back to even. That doesn't bother you. That's what passive investing addresses. Defensiveness has increased a bit simply because December became a declining month, and the Santa Claus rally did not arrive as it has so often in the past. Santa Claus apparently got stuck in the chimney on his way down, and he hasn't been able to get up and take off for the new year. And that addresses our portfolio risk. The largest risk are expected to be from the perception that current valuations in the market are extended or stretched, and they must correct. Yet when we look statistically at new highs generally lead to newer highs. You should not be afraid of a market that is posting new highs. In fact, if you were, you had in the S&P 500, you had 46 reasons to not be in the market last year because that's how many all-time new highs it posted. So if you were fearful of new highs, you basically stayed in cash all year long. Uh, Debt from a consumer standpoint and from a national standpoint remain concerned, but the political press regarding tariffs is dominating the fear aspect as far as potential risk are concerned. When we look at sectors, what we find is that the hindsight bias remains very strong and it overrides the fear of extended valuation. Technology is expected to be the best performing for the next year. And we find consumer staples, which are defensive, not so much interest there. And we get into the next one. We've got financials and energy. Energy's not been doing well until just recently, and it has started to turn up as new problems develop, particularly in Europe. But the energy demand globally remains very weak coming out of China, and they have been increasing their coal operated utilities at a massive pace, reducing their need to buy oil on the open market. They're still a heavy buyer, but they are not, with the slowing economy, they are not as heavy a consumer of global supplies as they have been in the past. And there's no real prospect for China turning its economy around. They're an export economy, not a consumer driven economy like the US and to some extent Europe. As an export economy, their continuing infringement of legal areas, either territorial or um, monitoring business and people and data breaches caused by Chinese interruption are creating great fear both in the United States and in Europe, other free parts of the world. And that's making China less attractive as a trading partner. That reduces their ability to export product, which further weakens their economy. And they are the major contributor to emerging market indexes, which means that they are likely to remain an unattractive area of investment. When we look at emerging trends, this is not emerging markets, emerging trends, and Perry just addressed these top two issues, artificial intelligence and quantum computing. And very close to that, we have drones and robotics, drones having been in the news a lot this last year. Robotics, not so much, but they are an increasing part of manufacturing development. And of course, we have autonomous automobiles. We've got these other areas that continue. Down here on the bottom is blockchain and crypto application. While it's on the bottom of this list, it still is 25% weight as far as emerging probabilities are concerned. With regard to energy, we have crude oil, the lesser part. This is nuclear energy, and that's being driven by the demand for data centers as the advancement of AI processing becomes an overpowering demand for power that is, in many cases, greater than many metropolitan areas. Perry, if you turned your microphone back on, you had some data about Microsoft's use of power. They have
Sure.
they've required a massive amount, and you mentioned some in our preliminary comments before people are online, some demand for power and application just by Microsoft alone.
Sure. They've already purchased
Three Mile Island. So they have their own nuclear power facility, and they've also announced that their plan for this year is to spend another $80 billion just by July on AI data centers. And so they're investing heavily in the data centers and the electricity production to run those, because they're actually running into a problem where there's not enough power on Earth to run all the data centers that AI wants to get started.
Thank you. And so part of the problem here with nuclear, well, that's actually part of the benefit with nuclear, is we now have small nuclear plants that are efficient, virtually risk-free, have a small footprint, and they can be built in a relatively short period of time, typically 7 to 10 years, and they can be built next door to your data center. So you don't have the problems of how do you get transmission lines across somebody's farm or through a dedicated forest that nobody wants to disrupt. There's a lot of environmental problems with building transmission lines heavy enough to carry the power that these data centers need. So nuclear is a driver for some utility companies. They already have plants or technology. Those areas are going to be more attractive for data center development. And if you can put in a new nuclear plant, then it is going to reduce the amount of citizen objection to what otherwise would be disruption from transmission line development. And you can see here that solar is very minimal. And as I listened to this morning's news with the cold weather that's going to be across the Midwest and to the East Coast for the next couple of weeks, high levels of icing, they are very detrimental to the ability to generate power either with solar or wind particularly. So crude oil isn't going away, but its dominance over the next decade will diminish. And then there's the estimates for where we'll be at the end of the year, with about a little over half expecting that we'll be around 6,500. So that's higher than where we are with the close of the year. The more optimistic is we'll be above 7,000. And then there are some pessimists who expect that the difficulties of the economy will drive the market down. So we have basically three cases here. We have a bullish scenario. The maximum looks like it's somewhere around 6,100 to 7,700 if you want to be really optimistic, about 30% higher than this recent close. And the market never moves in a straight line. So, I mean, it's pretty jagged. And what we see here is early part of the year may be a bit of a test, but the expectation on the bulls is that we're going to continue to move higher. We look at the bearish scenario. Again, markets don't move in a straight line, so we expect them that there will be a run up, a collapse, a partial collapse, another rally, and then really dropping down to perhaps a low that we haven't seen in a couple of years, about 45% below the recent close. If we take a look at this on an in-between basis, we end up with a higher year end than where we just closed, but we still have a modest drawdown in the range of maybe 25% or so, with a 58% increase, leaving us with a better year end. So if you're buy and hold and you close your eyes, none of this is going to bother you. If you're older, you don't want to go through that drawdown. You want some sort of more defensive strategy. That requires that you pay attention, or somebody's paying attention to your account. And that's probably not somebody in a major Wall Street firm, because they basically are assuming that everything is all happy days going forward, with Wells Fargo expecting that we'll have closed 15% higher than we did this year. And that's pretty similar with Deutsche Bank and Ed Yardeni, who I listened to on Fox Business on Friday, and he's very optimistic about where we go from here and does not believe that valuations are extended. So he's on the bull side of it. And then we get down here to UBS, and they're on the bearish side of it. The average is about an 8% rise. over the market. But issuing bear market forecasts is not what Wall Street's about. So in order to keep people coming in and investing and staying with them, you have to be an optimist about what's going on. As for us, we don't forecast anything because we admit we do not know the future. We've been in this business too long to make that kind of claim. We deal with what we see in front of us and adjust on the way. It's kind of like driving a car with a manual transmission. When you hit a hill and you need more power, you gear down. And when you're going downhill and it's going too fast, you use your brakes. I mean, that's a basic process for managing risk. The Santa Claus rally just simply did not pan out this year. Santa Claus rally typically is 7 days around Christmas and the first 2 days of the new year. And what we see here is this has been trending downward from mid-December through Friday's close. We do have some basic support in here. This major buy zone is where we find mutual funds and major other dark pool money managers are inclined to buy stocks. If prices get this cheap, they'll become net buyers, and as a result, they have a tendency to support index valuations. But they focus on the index components rather than the broad market. Though they have been net accumulators during December, the last part of December, they have slowed down and are accumulating less. Down here at the bottom, this is a negative indicator of weakness, is indicating weakness, and volume has been very weak, which is not uncommon during holiday season. The trend, however, for money flow coming into the market has been slipping all month long. Actually, began back in November. So going forward, we do have some issues to address. One of which is particularly for value investors, they often look at price to book ratio, and we are back at levels that are similar to the levels that brought on the end of the tech boom back in 2001. So we reached the high in March of 2000. Took about a year of people continuing to bet that it would run up, that this was a continuation into the future, only to find that in '01 that reality set in. A lot of those tech companies had no business. This time around, the companies that we're betting on as the marketplace, they actually have businesses. They have real profits that they're generating. There's something behind their website. So the correlation here that just because these numbers are equal or close to equal is not necessarily that the end is near. However, when we look at the bond market, we do see that that there is some issue that historically has been difficult, and that is when the spread in yields, the difference between the yield of a junk bond or high yield bond, to be polite, and a treasury bond, quality corporate bond, is narrow. When that differential is narrow, that usually means that investors are either not concerned about risk or perhaps not paying attention to the risk underlying the decisions they're making. There have been plenty of discussion about fewer rate cuts in the next year, but Powell dashed remaining optimism among bond traders in his last presentation in early December. The change in the implications for risk management is missing from most bond investors. They're basically accepting the lowest yield spread since the great financial crisis. That's what this points to back here. This has never ended well in the past. The yield spread is often the canary in the coal mine, using an old adage, as a leading indicator. So should we be concerned? Well, we need to pay attention. That's our mantra. Somebody needs to pay attention to this. This can exist as it is for an extended period of time, but as I just said, it often ends poorly. Since 1950, when we're looking at the Santa Claus rally, that's SCR right here, and this is the first 5 days, and this is the January barometer. So typically since 1950, when all three of these indicators are positive, the S&P is up 90% of the time the rest of the year. That's 29 out of 32 years, and an average gain of almost 18%. So all this is positive. Now, when one or more of the trifecta is down, in this case, the Santa Claus rally, the year is up almost 60% of the time, but the average gain is around 3%. That's according to the Stock Traders Almanac. However, it's not all bad. Even with the failed Santa rally, the January barometer is really what we're concerned about going forward this year. This chart shows that the Wall Street maxim of the January barometer has basically stood the test of time. Since 1950, the S&P 500 has posted an average annual return of about 17% when we end with a positive January. The index generated positive returns 89% of the time in these years that started out with a positive January. When that doesn't happen, the returns end up with about a -2, but that's only half the time. So we expect more volatility here as we get underway in January, but the end of January will be more critical for people who are forecasting and want to adjust investment policy based on that. But what we need for the bulls is a positive January. The market does have some work to cut out for it, laying ahead. This is relative strength up here, and it's in a negative trend. This is the 50 and the 200-day moving averages. They are trending down. If these were all the way down at the bottom, particularly relative strength, when you see it hits this lower level, that usually results in a rally in the market, which is indicated here. We got these low volume, low readings in RSI, and when that happens, we get a rally. Sometimes it can take a little while for those things to actually turn around and benefit, but it is something that we have not reached that level yet. So we're muddling around in middle territory, not quite certain whether the rally from last year continues, which philosophically, I think economically, we have opportunity to do that. But in the short term, uncertainty reigns. When we take a look about where to be invested, it's always a function of what's your time horizon. If you're an active trader, well, there's a lot of uncertainty here. Typically, looking at things on a monthly basis or a quarterly basis, the U.S. market is still a better place to be as far as versus bonds. This is a comparison. Low volatility or high beta areas, depending upon your time horizon. Large cap stocks. This is a reason not to be in small caps at this time. Broad market needs some broader exposure than just concentrated in a few of the leaders, though technology has been better than the broad market, but it is also much more volatile, and growth dominates, and the U.S. dominates over being overseas. Overseas investments have had periods of time where they lasted typically 4 to 6 weeks, maybe 2 months, and they can add returns to the portfolio, but they don't add return if you're buying and holding international stocks as a risk modifier. They've actually been adding risk rather than reducing it, which is a reason why we don't broadly diversify and stay with it. We stay diversified with leadership. We rotate out of things when they get weak. They aren't helping the portfolio. Last month we showed you this. This is where we were invested last month, and this is where we are today. So we have broad market and large cap growth. This model has a little bit of mid cap in it because it was at the top of the leaderboard when we last reset the portfolio. And similarly here, we've got large cap growth and some sectors that were at the high end of recent performance. So when I say you shouldn't be in international, it depends upon where you are in international. You have to, just like being in the U.S. market, which sector are you going to be in, as opposed to just owning a bunch of everything and pretending it will all work out. And if you are like Warren Buffett with a 100-year lifespan, then the things do have a tendency to work out. That's not most of us. And then this is dynamic, which is an active traded model. And we currently hold 45% cash in here, concentrated in technology, energy, and utilities. As I said, we're not in the prediction business. We're in the analyzing business. Where are we today? Let's deal with reality. This is what's working in the market. The markets are dynamic and they're constantly changing. Preserving your investment account is not for slackers. Buy and hold takes no work. That's what most investment models are. You answer questions from your financial advisor or on the website, and each of your answers is assigned a numeric value. Those values are added up and they put you into a diversified, globally diversified portfolio without regard to current market positioning, returns, or risk exposure, because your risk exposure is considered to be an 80-year time frame, but you're not 20 when you're making that investment. Someone needs to worry and watch and act, and you can do this. Now, what we do is not rocket science. It does take some software and it takes some time to learn how to make decisions and to follow your rules, to establish your rules. You can do that. We can do that for you. You can hire somebody else, but somebody needs to pay attention. If you have questions, you want help with your portfolio, just want a free evaluation, you can contact us. Here's the email. Here's our phone number. We have a YouTube channel for our podcast now instead of radio, but we're still using the IR radio for the shortcut. So sign up for YouTube, subscribe to our YouTube, go to our website and register there for the next webinar, which we'll be doing on the first Saturday of February.